We start today's market talk. In driving and investing, arriving safely at your destination is far more important than shaving a few minutes of your journey time or a few percentage points of your investment returns. So, once you have established a sensible, diversified investment portfolio, pushing for higher returns through risky strategies for some additional returns, the chances of additional returns are minimal, but the risk of catastrophic outcomes rises exponentially. Market outlook, as I see it, 2025 will see high volatility as long shadow of Donald Trump looms over the equity markets. Expectations are in the US of tax cuts, deregulation, growth, and US markets moved up accordingly. But US bond markets are not sure. So bond yields have risen, worrying about higher fiscal deficit and inflation, while non-US markets are fearful of tariffs. In addition, wars in Middle East and Ukraine, changing weather patterns, protectionism, and issues between US and China will keep the markets volatile. The strength of US dollar has been unsettling all other currencies. Tit for tat, depreciations of currencies may well happen, destabilizing economies. US bond yields have gone up as concerns over Trump tariffs and crackdown on immigration could lead to higher inflation, and that is why USD has strengthened, leading to capital outflows from other markets. One way to combat tariffs is by depreciating the currency, and there is already talk of China depreciating yuan. It can lead to domino effect. Risk is rupee may depreciate too quickly, and efforts to support the rupee by RBI will lead to liquidity being sucked out of the money markets. In addition, easing of monetary policy will get delayed as real interest rates have to be kept high to encourage fund inflows. That is the FIS flows or FPI flows. Continuous depreciation of currency is negative for FPI investors. Also, it increases import prices and leads to higher inflation. That is, you import inflation within the country. In addition, the exports also suffer as they may not be having the pricing power to benefit from weaker currency. So they may not be able to raise prices, but the imports are becoming costlier. The consensus among bond investors is that the benchmark 10-year government bond yield could slide to 6.5% by end of March from 6.8% right now. So this is one positive. Fall in bond yields generally leads to rise in bond prices. One of the reasons for fall in bond yields is expectation of higher demand from banks, mutual funds, insurance and pension funds, FPIs. Supply will be lower as central government has promised to consolidate its balance sheet and reduce fiscal deficit. Renewable energy ecosystem is set for transformative growth. India has set 500 gigawatt non-fossil fuel energy target by 2030. At end of 2024, non-fossil fuel capacity was 215 gigawatt. So India has to add at least 50 gigawatt of clean energy annually. Hence, focus will be on generation, storage, transportation, and usage for smooth energy transition. Rising stress in the economy is seen by zooming gold loans and sluggish consumption. Gold loans have zoomed at unusually high rates and is causing loan defaults. Gold loans have jumped by 50% year on year. These signs point towards serious distress at bottom of economic pyramid along with sharp slowdown in consumption. Another indicator is rising stress in unsecured and microfinance loans. Talking about US bond yields are after falling are now on an upward trajectory and have already reached 4.6 and likely target people are expecting is around 5% in next year or so. Dollar index, which had retraced to around 100 odd levels from high of 115, is now reached that 61% retracement, which I had pointed out last week, and now it is headed higher. So it may retrace from here and then again try to go back to the previous high, and depending on the way the policy issues work out in the US. Brent crude had a slight spike. It was up nearly 4% last week based on economic stimulus and lower interest rates in China. But still, it is within a range and is still not broken through the declining trend line. Gold is on an upward trajectory, has tested the 20 EMA on the weekly charts. So we'll have to see from here which direction it goes. It can bounce from here or come down and test the 50 EMA. Copper is on a downward trajectory, has broken through the 50 EMA, and now it is headed lower, basically due to weaker demand, due to economic slowdown in basically in China, and higher supplies. Bitcoin had corrected from after hitting $100,000, but after that it took support at around 90,000, and now it is bouncing back last week. So we'll have to see in which direction it goes. Nasdaq was up 0.68%. But the momentum has slightly stalled as people are in now wait and watch mode, and profit booking and also trading was low at the beginning of the year. Uh, Similarly, with Dow Jones, it had corrected after making a high of around 45,000. So now it is at 20 EMA. So we'll have to see from which direction it goes from here. India VIX corrected last week after hitting around 14 plus levels. Came down on came down on Thursday and on Friday also. USD INR is on an upward trajectory and has hit 85.74. So it is on a rising uptrend, and is the rupee is expected to weaken further, which is a big negative till the time it doesn't stabilizes, because the right now the trajectory is too steep. Now coming to Nifty on the weekly chart, firstly, along the 50 EMA, it has taken support now twice. Last week also it took exact support at 50 EMA. So hopefully in short term, the 20 EMA should provide a decent, 50 EMA should provide decent support. 50 EMA is at 43,440 odd levels. So we'll have to watch for this level. Right now it is above that. So that is not, it's at around 24,000 levels. Uh, the problem is that in the week ending December 16th, there was a long body red candle, which is the current ruling candle. Last week, we had a small body. The candle had a small green candle, but had a small body and a long shadow. Uh, bit There is a bit of resilience from lower levels, as these lows have not been broken as such. Uh, but last 2 weeks, the candles have been small range candles confined to the large body red candle of December 16, and inability of the trends to carry December 16 candle lower is telling us that we may have created a short-term bottom here or somewhere close to the November low. But uh, and also these two candles of last 2 weeks have not broken through at least 50% of this large green candle. Hence, the momentum is not there. And then it went up to the 20 MA and then reversed from there last week. So right now it's on wait and watch mode, and possibility of testing this December 16 lows is very high. So this should be level one has to watch out for. So if you see here, the December 16 low was that week's low was somewhere around this 24,500 levels. So this should be a crucial level. Now, Nifty was confined within this box for 7 8 sessions, and then it broke out on Thursday, but it reversed back it had covered this gap also, reversed back and came back into this box. So now this moving averages which are at higher up to 24,250 becomes critical. So once it crosses this, then the next target should be around 24,800 and then it can head higher. So first this has to cross this level, then 24,800, 850 levels, and then there is a possibility of up move. At lower levels, if it breaks these lows of 23,500, then it will test the November low of 23,250. So these are the levels which become critical, but below 200 EMA, the Nifty will become slightly weak. Hourly chart, so it got slightly oversold on 31st in the opening, but then it has risen. And then after touching that 24,200 plus levels, it has corrected a bit, but it has closed still above 20 EMA. For short term, it is positive. Nifty Bank, so if you see here, it reversed on the weekly chart, the complete slight up move it was having, it has reversed that. So again, this 50 EMA of around 50,000 should be critical level to watch. On the daily charts, if you see Nifty Bank has been again taking support at 200 EMA, so which is at 50,500 roughly. So first support should be at 50,500. If it breaks this, uh, the complete up move of Thursday was reversed on Friday, basically due to weakness in private banks. So watch out for this level. 50,500 is the first line of support, and after that 50,000. HDFC Bank has come up with weak update on Saturday, but the stock preempted the fall and fell around 2.48%, 2.5% on Friday only from the 20 EMA and has now come down to around 1750 level. So from here, the nearest support is 100 EMA at 1735. From there, it can test the 1700 or 16, the 200 EMA. So we'll have to see this. So it all depends on the management commentary, which will come on Monday. Reliance has made a low at around 1200. So we'll have to see whether it has made a double bottom and it rises up from there. For that, it has to cross these moving averages. Friday's close above the 20 EMA is positive and the RSI is also pointing upwards. Nifty midcaps is stronger. It was up around 1.67% last week and it has made a strong green candle above the 20 EMA. Similarly, with the small cap index above the election day highs and also above the 20 EMA and made a strong green candle. So it can build up from there. Uh, in December, the small cap index had made a fresh all-time high. So this is the one segment which is in momentum. I'll cover IDFC first a bit. Firstly, seeing the chart, it's in a downward trajectory, making lower highs and lower lows. So right now, the lower trend line is pointing to 60 odd levels. So, and from there it has risen and has come down to its 50 EMA. So it can go up from here. Right now, the trend is, though the moving averages are trending downwards, but the RSI is at divergence and it is going upward. So we'll have to watch this stock carefully. It will move basically on results. Now, the reason for this downfall is because the business performance was weak in the second quarter, though the interest income and etc. was up year on year, 22%, etc. And net interest income and operating profit was up 30%, but provisions were up 228%, which indicates that management expects big stress in loans in future. Hence, they are making these provisions, which impacted the profits, which came down by 77%. Now, one has to see this next quarter results and management commentary as to what is the stress on unsecured loans and MFI loans for this. I'll cover three stocks. First is Polycab. It has steadily grown its market share and now holds approximately 25 to 26% of the organized markets in wire and cables. It has a strong distribution network of 3,800 plus authorized dealers and 205,000 retail outlets. So its moat is its distribution network. Its business operations span across India through 28 manufacturing facilities, 13 offices, and 29 warehouses. The company has also served customers in 79 countries globally. The company's emphasis on power cables, low tension and high tension, and control cables, which are in high demand, position it strongly for future growth. Moving forward, it is expected to continue expanding its market share, driven by broadening of its product portfolio, such as addition of EHV extra high voltage cables. Its wires and cable segment has grown at an 18% CAGR over the last 5 years and is expected to maintain its growth, backed by strong demand and upcoming capital expenditure in the power and real estate sector. It has recently won large contracts worth 5,600 crore for development of middle mile network under BharatNet project, which aims to provide last mile broadband connectivity. It plans to invest 1,000 to 1,100 crore for upcoming 2 3 years, with major allocation towards cables and wire capacity expansion. The company plans to have its EHV cable production facility in Halol up because there is a huge demand for extra high voltage cables and running by end of FY26. FMEG segment, which includes switches, lighting, and fans, has faced challenges and incurred losses. A turnaround is expected in FY26 due to product realignment, new product development, and premiumization. Expect 20% to 21% revenue PAT CAGR over FY24, FY27 with a good ROCE of 32%. Now, if you see Polycab, solid quarter it had uh, last Q2, September. So the sales were up nearly 25%. Operating profit also was up. Margins are slightly lower. So profit before tax also improved. And net profit is also higher. So what is expected is that it had given itself a target of 20,000 crore revenue by FY26, which it had achieved early by 1 year. Operating margins are improving. So it is expected to improve revenues by around 20% every year. And profit is expected to now grow around 25% year on year. EPS is expected around 172 in FY26 and 212 in FY27, taking a mean of 190. This stock can easily trade at 40 to 50p. So at 40 to 50p, it can trade at a range of 7,000 to 8,000. ROC is improving and it's rising, and ROE also. Now coming to the technicals, it has not done much. It went up to high of around 7,600, but then it dipped. It has made a W pattern here. So it seems to have made a base near the 200 EMA. So on every dip, this stock is a good buying opportunity for long term. Next stock is Larsen and Toubro. Its current order book is 3.2x its FY24 core engineering and construction business revenue, providing earning visibility. Hydrocarbon segment and heavy engineering should continue to see improving margin trends. Collection across clients, including government, was healthy in first half FY25 and reflected in the working capital improvement to 10% of sales in September 24 versus 14% year on year. The strategy of focusing on the balance sheet while executing is clearly playing out. So it has reduced its working capital and debt. Buy-in markets support asset monetization plan. It has been able to sell its project development business. Expect 19% CAGR in consolidated EBITDA over FY24-27, driven by 23% CAGR in core EBITDA with strong execution and margin improvement on a low base. Its green portfolio is 50% of revenues in FY24 versus 37 in FY23. Solar and hydropower projects, power T&D, green buildings, water and resource conservation, solid waste management, and emission reduction through building mass rapid transport systems are some of the some of the projects it is undertaking. Rising share of domestic execution backed by orders picked up in the last 2 years provide margin comfort. So if you see their revenues, its overall consolidated revenues are roughly around 3 lakh crore, and uh, the order book is roughly 2x of that. EBITDA is improved, margins are now improving. EPS, it is expected to do around 135 in FY26 and 164 in FY27. Taking a mean for these 2 years, it roughly comes to around 150. So it can trade at 30 times. With the EPS growth expected of around 20% plus, ROC, ROE are improving. EV EBITDA is coming down. So roughly the target should be around 4,500 based on P, and that is the SOTP based targets. ENC, technology, and finance business, considering all of them. So the expected price by one of the brokerage is 4,600 for this stock. Now, if you see the charts, it has been taking continuous support at 200 EMA. Went below that, that was a big buying opportunity. So at every dip to the 200 EMA is a great buying opportunity for this stock for long term. It has done nothing over the last 6 months or so because it's stuck in a range along with the market, but it has not gone down also. Now, next is Siemens. It's a well diversified company with multiple business drivers across power, road, railways, and healthcare sectors, among others. It will benefit from margin traction as revenue rise on the back of higher decarbonization and digitalization spend, apart from improving T&D transmission and distribution visibility. Shareholders of Siemens will get one share of power division for every share held, and the power division will be subsequently listed on the exchanges. Competitive bidding linked substation orders and possibly one or two large HVDC orders should be on the horizon. At its first half FY24 analyst meet, company announced plans to double its power transformer and vacuum interpreters facility, and in FY24 meet reiterated their confidence in the expansion being value accretive. Capex plan includes Siemens Energy capex of 460 crore, smart infra capex of 400 crore, and mobility segment capex of 200 crore. This is 50% higher than the capex by the company in the last 7 years. So coming to their financial summary, uh, their order book is roughly 1.5 to 1.8 times their net sales, which are roughly 34,000 crore. And with improving EBITDA, so the profit should improve. They are expected to do an EPS of FY26 around 127 and 166 in uh, FY27. So considering a mean of around 140, 145, so this stock can easily trade at around uh, 50 to 60 times. So considering that, a target of around 7,000 to 8,000 should be a decent target for this stock. EPS growth is expected to be strong, and it is growing at 30% plus. ROCE is improving, and EV EBITDA, EV to sales, etc., are coming down. So margins are expected to improve as revenues rise further. Operating leverage is playing out as revenues are rising, as employee cost is going down. Cost control focus is also continuing, which is helping the gross margins. And net working capital as percentage of sale is now below 20%, so which is helping in terms of cost, debt cost. So coming to their charts, it had made a high of around 8,000. So now it has come down, taken support at 200 EMA, which is a decent level to accumulate this stock. So from here, roughly 7,500 to 8,000 next 1 year should be a decent target. And this is part of that India growth story, etc. So I finished. We will take questions now.